Hi, I'm Charlotte Moore, award-winning journalist and founder of Gregg Communications. Welcome to the Professional Investment Podcast. Each episode, we welcome a guest to the show to share their news story of the week. And this episode, I'm delighted to welcome Gregg McClymont, Executive Director of External Affairs at IFM. Welcome to the show, Greg.
Hi, Charlotte. Pleasure to be with you.
Please do tell us, what news story of the week are you going to share with us today?
The news story I thought was really interesting in particular is around inverted commas warning from leading economists to the Chancellor of the Exchequer that UK spending cuts would damage the economy. A story which doesn't stand in isolation. There's been a number of such warnings in recent weeks, and it speaks to the febrile politics and economics of the early months of the new government.
And what in particular is it about that story that grabs your attention?
Well, Charlotte, there's been an increasing focus on what might seem the rather arcane subject of the fiscal rules that UK governments impose upon themselves, because of course they're not imposed externally, they're imposed by governments themselves to give markets confidence. And we've seen really in the run-up to the election actually, and since the election, quite a lot of focus on whether a new Labour government seeking to invest to grow the economy will make various changes to fiscal rules to give themselves a bit more fiscal headroom, as it's known in the jargon, but really space to invest in the economy vis-a-vis their own fiscal rules, which of course are there to retain market confidence.
Yeah, arcane. I don't think it's arcane. I think it's fascinating. I'm sure all our listeners will do too, Greg. But tell us, because there's a nice point in that story, isn't there, about how she's going to change the short-term definitions. Talk to us a bit more about that.
Yeah, well, the story itself refers to Rachel Reeves's May's lecture, which she gave earlier this year while she was still in opposition, which spoke about moving to a position where essentially you could invest outside of the day-to-day budget accounting. So investment for growth, capital investment, would potentially sit outside the day-to-day accounting of government spending versus revenues, the budget. Deficit or surplus as it's currently and usually known. But actually, Charlotte, there's lots of different things in play here that have been covered in recent weeks. There's the issue of the way in which the Bank of England's quantitative tightening is accounted for in fiscal rules, and changes to those rules may provide some more fiscal headroom for the Chancellor. There's also other issues around the way that public sector net debt is calculated, and without going into too much detail, the fact that illiquid assets, which the government holds on balance sheet, actually are only attributed as a liability rather than alongside that as an asset, and a few more things like that. So there's a number of things going on, and it really speaks to that challenge which the government faces, which is it thinks it has to invest in the economy to grow it, to fix the foundations, to use the language which the new government favours. But at the same time, it's promised the country in the election campaign and markets that it will be fiscally orthodox, or at least fiscally prudent. So as usual in politics, there's a squaring of a circle going on here, and the fiscal rules, these accounting methods, are now find themselves at the centre of that squaring of the circle.
Yeah, whoever knew that government's balance sheets could be sexy, right, Greg? I mean, that is interesting as well. You talk about something being a liability or an asset that will unbalance the balance sheet. So I can see there's an issue around that. It's interesting, isn't it, that it's all sort of definitional, and it can just be down to accounting almost, and yet that can kind of introduce almost perverse incentives. So we've seen a lot of criticism, haven't we, of Treasury brain, where Treasury is incentivized to sort of like push out investment because then you don't bear the cost right now. But actually what you do in the long run is push up the cost more, making something more and more and more expensive. And there's been a lot of criticism of that under the last government, hasn't there?
Yes, and it's a problem that governments of whatever stripe face, Charlotte, the short versus the long term. There's incentives to make decisions to fix a problem short term. We might see increasingly are increasingly powerful versus what might be in the long-term interests of the country. And it is, I mean, the fiscal rules, they can be complex, and to your point, in the end, accounting is critical, and it does reflect the different emphases of, I'll say, the Treasury versus other parts of government. But I think something actually that's interesting, if as we lift it up to a higher level and look down from 36,000 feet, even the way in which the National Wealth Fund is going to be financially characterised, will it be on the government's balance sheet or off government balance sheet? That's still to be confirmed. I think it's likely that it will have to be on balance sheet, given the broader context of the way in which government tends to account for these sorts of investments. But I mean, that in itself, given so much talk about the National Wealth Fund and the role potentially that pension funds might play in those sort of investments, I think is another angle on the same issue we're discussing in our story of the week.
Yeah, no, and let's get into that, because obviously any investor is going to be interested in how the UK economy does. But we also know that this government is carrying on the agenda of the last government and very much wants to get UK pension schemes to help them to bolster economic growth. So do we have any indication of what they're going to be doing around that, over anything that's going to be coming up in the budget, or if we get a feeling of how that's going to develop over the coming months?
Yeah, there's a lot of moving parts. If we link it directly to our story of the week, at the highest possible level, pension funds want to invest in the UK economy where it makes financial sense for them to do so, in their members' interests, of course, when we're talking about trustee-run schemes. And I think where the link to the story of the week sits is that in reality, lots of things that the government is seeking investment into will need public money as well as private money to de-risk the projects in the financial jargon. And I think that's really striking, because we know that the Chancellor has been very interested in opposition, and I'm sure in government, Rachel Reeves, in Bidenomics, in the approach that the American administration has taken under President Biden, specifically the Inflation Reduction Act. And even before the election, Rachel Reeves was being questioned on, but how can you do Bidenomics, which the Chancellor has christened Securenomics? How can you do Securenomics without the finance that the US is able to bring to bear on these problems? And in opposition, the Chancellor was straightforward in saying, look, we don't have the fiscal firepower that the US has. We'll need to do things differently. And to be honest, that was the view that the previous UK government took as well. But it's challenging, isn't it? Because we know that lots of the energy transition technologies, the really critical ones, which are in early stage of development, but critical to reaching net zero by 2050, and even the UK government's mission for clean power by 2030 in the UK, it'll demand public as well as private investment. Otherwise, the risk profile is just not going to work in a number of cases, many cases for pension fund investors. So I think that's where the really interesting crossover to the story of the week lies. And I do think I've been involved now for a number of years in these sort of debates, working for one of the biggest infrastructure managers in the world, who are owned by pension funds. So very much kind of being involved in these debates. And you do see, Charlotte, lots of talk about financing mechanisms. Is there a magic pill? Is there an incredible solution out there, financing mechanism which will crowd in pension capital and other types of private capital to deliver these projects? And in my experience, the reality is that although financing mechanisms have to be adjusted depending on the type of project, risk profile, income streams, construction risk, etc., in reality, so much comes down to the amount of public finance available to persuade private capital to come to the table and invest. The most, and I'll stop here for a moment, but the most striking example, and it's certainly an extreme one, is nuclear. We saw just the other week that the government's committed another 5.5 billion, I think it is, to Sizewell C, to the development of Sizewell C. That's a project where government's on record as wanting to crowd in private investors to share the equity with the government and the constructor. But to achieve that, the de-risking is going to have to be very significant for reasons we might or might not want to explore with reference to nuclear specifically. But I think it does stand more broadly if an extreme example of the reality that it has to be public money and private money.
Yeah, I mean, I think if we kind of like take it back to sort of investment 101 almost, something that you learn in investment is something called the capital asset pricing model. And basically the concept of that is that the cheapest form of cheapest form of investment is sovereign bonds. And everything else on top of that, any investor above that is going to want an additional return. They're going to want their premium on that. That's the fundamental point of the CAPM pricing, of CAPM model. So if we think about it from those terms, you know, the cheapest way for the government to fund all of this is to issue their own debt. If we exclude where the balance sheet is and everything else, the cheapest way is to issue their own debt. As soon as they get external investors involved, they're going to want to demand a premium. And a point that somebody made to me recently in an article was, you know, it's all, you know, pension schemes and the like, and any other investor, in fact, it's not just about UK pension schemes, global investors will be very happy to be involved in the green transition, in bolstering the UK economy, but they're going to want their premium for it, which is another way of what you're saying, because risk return is all about the same thing. So if the government is happy to manage the risk, but give away the premium to somebody else, it'll work. But they will come in for criticism of that, as they have done in the past when we had PFI and all the rest of it, you know. So there's a tension there, isn't there? There's a balancing act to be found in that, in your sort of desperation not to add to the public purse, not to increase the balance sheet anymore with any more debt, you are going to have to give something away to all of these investors. And I think that's an interesting debate that's sort of had on the sidelines, but maybe not in the main public sphere.
Yeah, I think that the term "give something away to investors" is worth interrogating, because the challenge that government faces, and this would be not just in the UK, is of course that governments can borrow much more cheaply.
Yeah,
you know, their cost of capital is lower in the argot, and therefore, if you're committed to pension capital or other forms of private capital, but pension capital that's got a lower return target, of course, than some other forms of capital, nonetheless, it's going to be more expensive, depending on how you define value for money. What I think the challenge that governments find themselves in is that when they look at the cost of capital, it looks much cheaper to do it on balance sheet, but then they run into the challenge you've just described about how much debt can be taken on the public books without the markets reacting in a negative way. And, you know, for a variety of reasons, the short-lived Liz Truss government, of course, ran into that problem of bond market reactions. But also, I think this is the hardest thing for government, in the being realistic about the likelihood of government undertaking the project. So often the kind of value for money approach is to say, can this be done in a private investment way for value for money? But that's often defined against what it would cost, as we say, for the state to undertake it. But I think those metrics demand some interrogation, because if you look at HS2, of course, depending on the inputs, I think it's turned out to be a lot more expensive for the taxpayer than even the more sceptical Treasury mandarins suspected. And also alongside that, really just accepting that if some things are going to get done, private money is going to have to deliver them, but alongside some public money. The Canadian Infrastructure Bank is quite interesting in that context, because my understanding is that it was set up explicitly to bridge that financing gap between the public cost of capital and the private cost of capital, on the basis that these projects are only going to be delivered by private investors, pension funds or otherwise, and therefore our job as government is to is to provide that financing which allows them to deliver the project at the rate of the return, which is the minimum they can accept. And I think it's that kind of approach which is, is really quite interesting to think about in the UK context.
Yeah, and I mean, that kind of goes to your point about risk as well, is that, I mean, one of the things that strikes me is I can see as a government, you can look at all of those lovely trillions swilling around in pension schemes and think, oh, I want a bit of that. But the point is that pension schemes may not be the best people to invest in particular projects for you because of their risk appetite. They're not going to want to do beginning bit of venture capital because of their risk appetite. They like private equity a little bit. They maybe like the growth capital bit in between VC and private equity. Same with infrastructure. They want. They're very happy to have an infrastructure product that has a very guaranteed income stream, but they maybe don't want the risk of the beginning bit of it, especially when that all is tied up in planning risk, like HS2. It would not have been expensive HS2. We have this crazy planning system where we end up with these massive legal fees to try and cover every eventuality of how something can be challenged. So there's so many moving parts to it, isn't there? You've got to get the planning regime right. You've got to figure out which is the right risk, which is the right return for what type of capital investment. There's a lot of moving parts to it all, isn't there, Greg?
Yeah, and risk profiles absolutely vary between types of investors. But even, and let's take that on, but just before we do that, just finishing on the Canadian Infrastructure Bank, it also has a mandate to, inverted commas, lose money, as in, from a whole national accounts point of view, its job is to drive investments in largely sustainable assets, and in doing so, it's allowed to lose money, inverted commas, which is not the case with the UK Infrastructure Bank. So even at that level of state institutions, there's that question of actually what's the risk appetite and what's the return demanded. And I think you take that on to your very good observations around risk profiles and the like. Absolutely, it will depend on projects. I think if pension funds are big enough, and this, of course, is where the consolidation agenda comes in, if they're big enough, they will make allocations to VC and growth equity, but they need to be very big. So if the government is really committed to getting UK pension money on a voluntary basis into VC and GE, then actually it's going to have to will the means as well as the end, which means, I think, pretty rapid and aggressive consolidation. More broadly, when you look across the sector of the energy transition, it will depend, won't it? The success story that's always pointed to rightly is offshore wind. And basically that was a lot of public money up front in 2012, 13 and so on. And that worked very effectively. And CFDs could work in other sectors. But again, it's about the government's ability or appetite to put the public money on the table to de-risk. Sustainable aviation fuels is an obvious one, actually. It's pretty clear what needs to happen there in terms of creating a market and building sustainable aviation fuels into the day-to-day over time supply. But who's going to pay for it, Charlotte? Who's going to pay for SAFs, as they're known, until they are cost competitive? And of course, we can see that across a number of technologies. Hydrogen, green hydrogen is an obvious other one, but there's many of them. And I do think, I say that, as I've said already, I think it does bear repeating. I've been in lots of conversations and roundtables where the focus is on mechanisms, but in reality, I think the quantum of public money is critical. We have to be realistic, I think, of what's achievable, depending on the firepower that the UK government is able to bring to the table.
Yeah, I mean, it's about working together rather than apart. And I think that that's kind of missing at the moment in terms of, I feel my sense from sort of events that I've actually created and chaired is that there is still a big schism between the financial community and politicians and civil servants, just in terms of understanding how each other works. and what the risk appetite is, and how those, even I feel sometimes that the government itself doesn't really understand how its own regulators shape how different pension schemes invest. There's a lot of conversations that need to be had, and a lot of bridge building between the two communities if they are really going to work together to make really effective long-term change in the UK community, in the UK economy, I feel.
There's a really interesting observation about the understanding of pension funds, because it is the case in the UK, because of the way that the system developed, maybe over a long period of time, there isn't a great amount of knowledge, perhaps in places where you might expect more knowledge of the system. And I sometimes compare it to Australia, where, I think because the system is defined contribution and has been clearly for 30 years, I would say the understanding of the system as a whole amongst politicians is a bit higher. I think in the UK, because the system was largely DB, which does take a bit of understanding, there maybe isn't that deep domain knowledge that one might expect. And it is more complicated as well, to be fair. So in Australia, you've got a DC system, you've got different flavours of DC providers, you've got pension funds, and then you've got pension providers, as we would understand it. So you've got profit to member, as the Australians call it, i.e. not-for-profit pension funds, and then for-profit commercial platforms and providers. In the UK, it's more complicated still, isn't it? Because you've still got DB, which is a large part of the debate, open and closed DB, and then you've got various flavours of defined contribution, some of which are pretty new. So I think that's part of the problem, that it's actually quite a difficult learn for policymakers to get their head around the different parts of the system. I'd say it took me a good year when I was Shadow Minister, and I was fortunate to do it for 4 years, to really get an understanding of the different parts of the system and understanding the relative importance as well.
I mean, I joke that the first decade of being a pension journalist is the hardest, and after that you kind of understand it. But you're right. I mean, if you had a blank sheet of paper, you would not start from where we are now. It's highly fragmented, as you say. There's kind of 3 big pots of money: open DB, closed DB, DC. Then within each of those, there's massive sort of legacy and complication, fragmentation within fragmentation, which makes it very, very difficult. It's highly technical. If we talk about the shaping of how regulation shapes what DB do, the kind of the motivation and who regulates the PLS, the LGPS. The PLSA has a wonderful slide that just looks like, it looks like somebody in a fevered LSD-driven dream put it together. It's so complicated, got so many colours and arrows. So you wouldn't start here, and so that makes it very complex. Something that somebody said to me in an event recently, which I thought was really interesting, is when we talked, I've mentioned the sort of the tension between the financial community and policymakers in terms of not understanding each other. But I think there is, and nobody would admit this publicly, but there is kind of a bit of resentment about being seen as the piggy bank that can be raided. And there is also a feeling that it's not just about pension schemes being forced to invest, but the government doing its job as a government and making the whole of the UK investable. And actually, if they did that, it would be far better for the economy as a whole, because you would make it much more attractive, not just to your own domestic institutional investors, but to all those enormous global institutional investors that we talk about all the time, whether it's Canadian or American or even Australian. Do you think that the government maybe misses that point sometimes, that they're seen as being too sort of desperate and greedy to maybe be extreme, and that they should be thinking more about the economy as a whole and making it investable?
Yeah, to be fair to governments, they're looking at the situation where UK economy's chronic problem has been lack of capital investment. And when they look at household savings, the largest source of household savings in the UK is pensions. And then they look at Australia, Canada and so on, and they think, oh, wait a minute, these funds are investing in the UK in significant volumes. Why aren't our pension funds doing the same? Now, we know the story is complex and a lot of it's to do with DB. and the fact that DB's in runoff, and actually that speaks to the disconnection between pension system and politics, because of course this has been a long process of DB funds de-risking, but the implications for UK capital investment have only very recently caught the attention of policymakers. So I'd have some sympathy for government in the sense that they've got a problem which is about capital investment, and they want the UK to do its bit in its own economy, and pension funds seem the obvious source. And saying that, the pipeline is critical, isn't it? So you could get a big focus on pension funds should invest more. What are they investing in? And that's clearly, to our conversation about the energy transition, going back to the news story, that pension funds want to invest, but the projects have to be, have to have the right risk profile. And that's definitely a challenge. When you look at nuclear is an interesting one. I mentioned it earlier. I mean, you could get funds to invest in nuclear, I think, but it would involve de-risking, the project almost entirely, because obviously the construction risk is profound in nuclear, and the income doesn't start being thrown off until it's built, which is usually a number of years over the planned turning on. But I think it's just it's an extreme example of the broader case, which is that the one that you make, which is the risk profile of pension funds is such that they're not prepared on their own to take some of these risks. That's where the scale does become very important, because when you look at the big Australian pension funds that own IFM investors, they've been doing venture capital growth equity in Australia for a number of years now, and pretty successfully, and the energy transition too, increasingly. And that is a function of scale, because of course you can make a small absolute allocation, which in percentage terms, but in absolute terms is quite significant. So I do understand in that context why the government seems so keen on scale, because scale does tend to change the flavour of these types of debates, I think, Charlotte.
Yeah, and I mean, I do think that some of these investments are a more natural fit to these institutions than others. And the thing that you specialise in infrastructure is very much more a natural fit. I mean, we already have the LGPS investing quite heavily in infrastructure. And even insurance companies, the trickiest, most difficult institutional investors to keep happy because of their tight regulatory regime, invest in infrastructure. So there's definitely sort of quite a lot of scope, I think, for, as you say, the right infrastructure project with the right risk return profile. And, they would be keen and happy to invest in it because it would sit within their regulatory requirement. So it is a matter of perhaps a better understanding of what kind of project fits with which kind of investor and how you court that particular investor, whether it is a pension scheme or a venture capitalist that has nothing to do with pension money whatsoever.
I think that's right. And expertise really matters. When you get into infrastructure and you're owning large assets, the asset management becomes pretty important. So I go back to the scale. There'll be some UK pension funds that are at that scale. USS is the obvious example that's got a big private markets portfolio. But the asset management, what I've noticed the last few years doing this is that the asset management is really important, because really the payoff in these kind of assets is the investment in the assets themselves over the long term to enhance their attraction to customers and therefore their long-term value. It's not a kind of quick buy and sell sort of sector infrastructure. So if it's about enhancing the value over the long term, you need to know how to enhance the value, which means the asset management becomes very important. And yeah, I think infrastructure is an obvious place, and as you say, pension funds, the bigger ones, are already doing this to some degree. I think that the greenfield brownfield is an interesting place to talk about, because historically the focus has been on brownfield, of course, but investors and funds have started to go up the risk spectrum and looking more at greenfield. And clearly in the energy transition, there's going to be quite a lot of greenfield. So I think that's where expertise does really matter. As you know, the way the Australians approached this was the funds 25 years ago set up their own manager, which is what IFM became, to basically provide an in-house source of expertise. Because in doing this kind of stuff, you really need to know how to reduce the cost of intermediation to make sure the full value goes back to members. And that's how the Australians approached it. And it's a bit different. We talk about the Canadian system because it's not so much a system as 8 funds in the public sector. The Maple 8, who are outstanding investors, but public sector DB funds. So you've got the public sector DB funds in Canada as a model, and the Australian DC sector-wide funds potentially as a model for UK DC. So there are examples, to learn from for sure. Well,
I think that's a wonderful point to leave our discussion. That has been truly fascinating. Gregg, you never fail to disappoint. You never disappoint. Not you never fail to disappoint. You never disappoint. Thank you so much for your time and for sharing your news story of the week and all those insights. Listeners, I hope you enjoyed the show. Want to make sure you never miss a future episode? Then hit the subscribe button below. And if there's anybody you would like to hear or see on the show, then get in touch. Thanks for listening.